Welcome, everyone, to the IntentGen Financial Partners third quarter market update. We have a great agenda planned for you today and look forward to diving into a lot of tactical information on the markets, the economy, looking back on this past quarter and what's planned ahead. My name is Jacob Schatz. I'm a partner at the firm and I'm joined with two of my colleagues, Pat Morris and Andrew Abel. So, if you recall from what we've typically done on a quarterly basis, is we went high level on market growth, and then we've dove into some of the topical items. So, from a high level, we've really seen a positive growth year overall across all the asset classes that typically represent our portfolios. On the left side of the screen, we have our darker blues. Those are our bond funds, our positions that are in treasuries and U.S. core bonds. So we're seeing both yield and return from a variety of categories as we've seen a number of interest rate cuts. But core bonds up 6.1 for the year, high yield up 7.2, even longer dated maturities are at 6.6, and then foreign bonds are at 5.8. We've seen more modest growth on a quarterly basis, really averaging around 2% across the board. Foreign bonds are still flat. In that lighter gray, we've seen some disparity with international and developed for the year, leading the way at 25 and 27% respectively. S&P 500 at 14.6. And then small caps, if we recall back in April, those got hit the hardest post-tariff announcement, and they've really recovered well. And so the two spaces that have been hit the most have started to do much better on a quarterly basis, with small cap up 12.4%, and then historically emerging markets have lagged these other indices. This year they've done better, quarter to date up 10.6. And then, as you know, we always have commodities in some way, shape, or form, either through real assets. We have REITs, we have energy, but real assets up 11.5 for the year, commodities up 9.4, and then REITs are up 4.5. So overall, forward or a backwards looking great view on asset class returns, and then we're going to dive a little bit more into what's influencing that, specifically starting with the U.S. dollar.
Yeah, thanks, Jacob. It's been a great year for international stocks, both international and developed markets and emerging markets. And part of that story is the dollar tailwind for the non-US stocks. So as you can see, the US dollar index has been down 10%. So that provides some nice tailwind for foreign holdings. But it's not the full story. What we have here is we looked, and if you see here, the international markets outperformed on a local currency 17.4% versus the US 14.6, and then the emerging markets did 24.3. But it's not just one region, and it's not just Europe, it's not just Asia, it's not just emerging markets. As you can see here, a lot of the markets have outperformed on a local basis, and then also on a pure with including the tailwind from the dollar. So some examples: China has been up 41%. A lot of optimism around AI. Alibaba and Tencent, two of the bigger companies in China, and a very accommodative government policies have helped out China. And it's not just Asia, though. Germany and the UK, a lot of European, as you see here, Italy has done well. France has not performed as well as the US, but with the dollar tailwind, it has outperformed, as has Korea and Canada. So a lot of good returns locally, and then with the dollar tailwind. And speaking of government policy that I was talking about, or lack thereof, I'm going to turn it over to Andrew to talk a little bit more about the government shutdown and tariffs and some stuff like that.
Yeah, thanks, Pat. Appreciate it. As a lot of you know, this isn't really the first time we've gone through this. It's been around for quite a while in terms of government shutdowns, dating back all the way to the Ford administration. If you look at a straight average of previous times, given this graph here on this slide, it's typically around 8 days that the government is shut down. So we're well over that at this point. But really, what we're doing is looking at the the items on the bottom right of this slide, there's a lot of items that have impacts on this, but these are the things that we're highlighting in financial markets regarding the shutdown at this point. So if we go to the next slide, we're going to talk about market impact from government shutdowns. A lot of mixed results here, but oftentimes there tends to be a delay in economic growth from a government shutdown. But if you look at the average return during government shutdowns, we're at about negative 0.1%. So given this data, we don't really see a need to make any immediate action or changes on portfolios and rebalancing. Next, I wanted to touch base on tariffs. I know a couple quarters ago, tariffs were really, the main topic that a lot of people were talking about. And we're starting to see an impact on the market now as they're being implemented and flowing through to companies and consumers. But they've really taken kind of the back seat in terms of headlines in the news at this point. And it's more about incremental changes or the resolution. So many businesses front-loaded and bought a lot of inventory in the first quarter, and that's starting to roll off at this point. And we're starting to get into holiday season, which is a higher consumption season in the US here. So businesses and consumers are going to have to make some decisions. There's going to be higher costs of goods, and they'll have to decide how they pass that on. How much businesses pass on to the consumer, that'll come through as inflation to us, which we saw given the recent CPI report about a month ago here. If they do decide to eat it as a business, we'd expect lower profit margins. But I just wanted to touch base on this a little bit here. In Q4, we'll talk a little bit more about it as we'll be rebalancing portfolios and discussing the outlook a little bit more for 2026. So lastly here, just wanted to touch base on the labor market. If we look at this table on the left, about the last 12 months, it's remained relatively flat, around 4 to 4.3% for the unemployment rate. It's been an interesting job market in terms of the ratio between hiring and firing, and we're starting to see some changes within that at this point. But job openings versus the unemployed, it's around the 1-to-1 ratio now. Before, if we look at 3 years ago, it was in that 2-to-1 ratio. So month over month, we have seen some decline, but there's other shifting dynamics in the market, such as the immigration policy that have potentially lessened that impact. So now I'm going to pass it over to Pat here, talk about the Fed cut a little bit.
Yeah, thanks. So as we know, the Fed has cut interest rates now twice in the past 2 months, one in September and one in October. And now the rate stands at 3.75 to 4%. They do it in a range. And the last cut before that was in December of 24. So it was a 9-month pause, which seemed like a long time. I guess we just got used to the previous cuts just seemed to be more stepwise, where they would cut every meeting or every other meeting. But in reality, historically, there's been an average of 10 months between pauses, or 10 months is the average pause. So this isn't out of the ordinary that we would go that length of time to see another Fed cut. But now let's just dive deeper into what's the Fed trying to do. And instead of trying to figure out the path, let's try to figure out the destination. The path is, what is it going to happen in December? Is it going to happen in January? Is it going to happen in March? When what we're really trying to figure out is what level are they going to get to, and what's the Fed's mandate, or what is the Fed trying to accomplish? Well, the Fed really has two goals. One is to be full employment. So full employment, depending on who you talk to, is anywhere between 4.2% and 4.6% unemployment. So we're kind of there. And then to keep inflation benign, which would be right around 2%. So if you take this 2% inflation and then add a percent, a real return, 1% to it, you get something that economists will refer to as R star. And R star is a theoretical number. So basically what they're trying to get to is the 2% in inflation plus 1%. And anything above that, they might try to, as if you're going to use the analogy, they might put their foot on the brake to kind of keep things to slow it down. And anything below that, they'll try to put their foot on the accelerator and ramp it up. So, but they hope to get to a point where it's neutral, right? We're not putting our foot on the gas or on the brake. So what does that mean for where we are right now? Well, the 2% inflation plus the 1%, the 2% inflation is there's always been a sticky number that they've been trying to get to. And because of structural changes in tariffs, that seems like an unobtainable number. I think we've saw it down into the 2.5 range or in and around there. So if you would say 2.5% and then a one-ish type of real return on there, then you're looking at about a 3.5% Fed funds rate. So right now we're at 3.75 to 4. That means we have room for 1 to 2 more cuts probably. This is something we're going to focus on a lot, or focus on when we do our 2026 expectations coming up in a couple months. But that's the kind of driving rate that they're going for. So there is room to get to lower rates, whether it's in December, January. People, had when Powell came out and started talking about maybe not a rate cut in December, people got a little flustered. But it's kind of where we're going, and not as much as how we're getting there, but where we're going. And one of the bigger benefits, or the biggest benefits of lower rates, would be small cap stocks, right? So it kind of makes sense. You think about it. Small cap stocks are leveraged. The weighted average debt divided by EBITDA on small cap on the S&P, excuse me, on the Russell 2000 is twice that of the S&P 500. So they carry more debt, and the interest expense as a percentage of total debt on the Russell 2000 is higher than the S&P 500. If you see there on the chart on the right, it's 6.9% instead of 4.4. So small caps companies really rely more on, or are more interest rate sensitive. And that's why you saw outperformance in that area in the third quarter, not only because of the rate cut, but the anticipation of the rate cut and the optimism from the rate cut. But it's not just that. If we look at earnings and earnings expectations, the shift, they're optimistic for the S&P 500. If you look here, there's still a lot of optimism around the Mag 7 and the artificial intelligence craze that's going on. The numbers for next year show good quarterly growth year over year. And it's even better for the S&P 600, which is, the equivalent or the small cap version of the S&P. So they're looking at almost a 25% increase compared to a 17% increase in the S&P 500. So although the S&P 500 looks, there's optimism there, there seems to be even more optimism on the small cap. But let's go back to our old friend, the S&P 500, and what's old is new. So we focused on this in 24 and 25, beginning of 24 and then the beginning of 25. This concentration we see in the top 10 stocks in the S&P 500. It's hit a new all-time high. It's about 40%. So you have your Mag 7, and then you have 3 other names. Together, they make up 40%, and it's never been that high. But unlike what we saw before, like during the internet craze and some other times, where these stocks or these prices really weren't, I won't say weren't warranted, but right now, about 1/3 of the S&P 500 earnings come from these top 10 stocks. So companies, so they're deserving. Now there is still some optimism, but these companies make up 33% of the earnings. Take a company like Microsoft, for example. Microsoft is a large company. It's one of the largest. It's obviously in the top 10, and it makes a lot of money. So that's where the earnings come from. But if you say, okay, well, they make up 40% of the index, but they're only 33% of the earnings, there's still room for optimism, right? And a lot of that optimism obviously is coming from around artificial intelligence and the spending that has gone on there to generate additional cash flows or additional profits. You can't help but, you pick up the paper, you'll read about the Mag 7, and, they're just, Microsoft just tried to hire a software engineer for a $100 million signing bonus. Now, it sounds like a baseball term, but I mean, it's literally it was later debunked, but other people came out and said there have been significant signing bonuses by people that they're trying to get into AI. And while spending on AI is not new, the magnitude on which the spending has been happening has really ramped up. So much that the free cash flow, so that's kind of the money, the capital expenditures that are going out, and the profits or the revenue that cover that has kind of fallen. So this is, I won't say an alarming chart, but something that we pay attention to, and rightfully so. The S&P 500 is a cornerstone or a holding in all of our portfolios or most of our portfolios, but it's not the only one. Like we build portfolios around durability and diversification. So the small cap that we just spoke about, we have those in portfolios as well as the S&P 500. We have international that I talked about earlier. So we have many equities, and we also have some real assets and also fixed income, which have been having a very good year. And with that, I'm going to turn it over to Andrew to talk a little bit more about some fixed income numbers.
Yeah, thanks, Pat. Like Pat said, overall, the fixed income market still looks fairly attractive at this point. Just to give you some guidance on this graph here, the higher the number is on the graph, the more attractive it is relative to history. So a lot of the fixed income market is above that 50% rank and higher. If we look at munis, it's at 71%, cash and short term, 77 and 74%. But there are a couple on the bottom right there for those spreads that are lower at 0% and 3%. So there are some risks with fixed income, with defaults being that risk lately. The spread for additional yield that you earn for taking on default risk is very tight, about as tight as we've seen it in the past 20 years for both investment grade and non-investment grade. So I'm going to pass it on here to Jacob just to finish up the presentation and talk about some items for Q4.
Yeah, thank you, Pat and Andrew. Some great content, great look back, and also what's to be expected going forward. And right now, we're in a heavy review cycle with all of our clients, as you likely know or are going to know. We got to celebrate a great community event with Casino for a Cause. We raised over $100,000 for 19 local organizations. We got to celebrate Candy Egan's retirement, and then welcome on John and Heather as new colleagues as well with the firm. So looking forward to meeting and reviewing with a lot of you individually. Just high level, we're going to be focusing on, if it makes sense, Roth conversions prior to year end, perhaps based off of basis. And when you bought into it, there's some tax loss harvesting, which might make sense. Capital gain information is coming out shortly, so we'll be reviewing that to see if there might be a distribution that is impacting holding that position long term. Qualified charitable distributions, so RMDs that we can direct, or distributions from IRAs that we can direct directly to a charity, avoid that tax on that. Charitable gifting, perhaps rather than tax loss harvesting, if we have highly appreciated securities, we can either gift those directly to a organization and avoid that tax, or we can use a donor advised fund. And then, as they've alluded to, over the next few weeks heading into the end of the year, we'll be reviewing, finalizing, and updating our 10-year capital markets forecast, which is really the strategic look on what we can expect from a return and risk standpoint for each of those asset classes. That helps us guide into our fund review and then the individual targets there. So a lot of good stuff to come. We greatly appreciate your time today and hope that you found this information available. As always, if you have any questions, don't hesitate to reach out to any of your dedicated planning coordinators, service coordinator, or myself included. Information as well on our website. But thank you so much. We appreciate your time and look forward to updating you at the end of the year.
Thanks, everyone.